Morgan Stanley expects developed market equities to deliver returns in the low 10s over the next 12 months, and U.S. equities should lead the global market gains. S&P is forecasted to gain 12% in the next 12 months on the background of resilient earnings. The index's Q1 results beat expectations by 6%. It's the strongest in the past 4 years. And look at the picture at the right. These are the quicker recover in the index after a 5% to 10% pullback. There's a quick one this year on January 27th, which took 16 days for a recovery. So even with volatility in energy markets, risk assets are still supported by macro and micro fundamentals, highlighting the resilient earnings, at least for publicly listed larger cap companies in developed markets. When investing, be constructive and not complacent. While AI is the trend, there'll be some pressure on credit markets, which means fixed income and bonds. And the main risk for Morgan Stanley and most is if inflation in the U.S. accelerates to a level so high that the Fed could not ignore and must increase interest rates. That is the main risk that will linger all the way till this year, or even first half of next year. Corporate credit will face supply pressure. Fixed income market, especially AI-related ones, will lag other asset classes because capital expenditure, CapEx, for AI-related companies have gone up even more, and most bigger and listed companies will issue debt or bonds to finance their AI-related CapEx. So when there are a lot of bonds available, investors will demand better terms. There are many more new bonds to choose from, and CapEx for the 5 largest U.S. tech companies have risen to $800 billion. This is their long-term expenses that they require to reinvest back to the company to sustain and grow. So expectations of U.S. economy are it'll slow down, but without a recession. And uncertainty surrounding oil prices will continue putting pressure on the U.S. Treasury and the government bonds. Currently, yields are at very high levels. There are a lot of selling activities, and the complication is many consumer loans are pegged to the 10-year or sometimes shorter U.S. Treasury. And so then naturally, lenders will increase the interest rate. But on the bright side, likelihood of recession is low. U.S. dollar will likely remain weak. Part of the reason is confidence level. And another reason is towards the end of this year, if U.S. core inflation moderates and the expectations of interest rates increase will drop. And if Fed cuts interest rates, deposit rates will be adjusted lower. Money markets as well, making the appeal of U.S. dollar lower. U.S. dollar level should reach a bottom and start to recover into next year, 2027. But because of the strong economic growth in the U.S., more capital will go into U.S. Let me just highlight India. This is what's happening in India. Many Indian companies are putting more capital into U.S. Investing more into U.S. and FDI level has dropped quite a fair bit. Onto euro currency. The French presidential election next spring could increase concerns around political risks in Europe and weighing a little on the currency level. The base case scenario is Strait of Hormuz will begin recovery in mid-June, but logistical and operational challenges will still keep oil markets tight throughout the rest of this year. That's saying that prices will still remain high for this year. And for gold, which underperformed other asset classes since the start of Iran war, could likely recover as more central banks and more ETFs resume the physical purchase of markets. And tying to previous point, if USD remains weak, then the dollar money market will be less appealing and more attention will fall on gold, because both are more or less categorized as the same risk levels, and gold is usually tied to US dollar. So when US dollar drops, the entry point for gold is more attractive. So on to Germany. Q1 for them is their best performance since beginning of last year, but Q2 this year might not be a good one. Q1 came in with a 0.3% quarter-on-quarter growth driven by public consumption and exports, with high oil prices and supply chain freight and logistic friction going on. And this is not China, where they can produce products at a very cheap price. This is Germany. When you see that the main drivers for growth are public consumption and export, this isn't a good sign. Firstly, high oil prices and supply chain logistic friction will affect exports. And then, public consumption, it means goods and services provided by government funded by taxpayers. This is simply government spendings that is part of the GDP calculation equation. The more important areas are private investments and construction, which are both unwell, and private consumptions, which had no improvement. That's a bit concerning. Looking at ahead, energy prices are expected to stay high. It's hard to see German exports able to repeat the strong performance in Q1. Private consumption, which is the consumers, will unlikely recover. This leaves the public sector, which is government spendings, as the only possible source of growth for Q2. And that's not good. Look at the KPMG picture at the right. Most entities downgraded the growth forecast. And Germany is important because it's the third largest economy globally, and more importantly, the largest economy in Euro area. Staying on the topic of private consumption, let's look at EU consumers as a whole. EU private consumption contributes almost 52% of the entire Eurozone's growth, and high fuel prices will undermine private consumptions. Looking at the bigger economies in Euro area, Germany and France, most people tend to drive. And because of high fuel prices, residents face greater financial burdens. Netherlands is experiencing the sharpest rise in fuel costs, reducing their disposable income. At this table below, this is the ranking of the top 8 economies in Eurozone. Germany, France, Italy, Spain, Netherlands, all are feeling the impact. And look at the graph at the right. 2025 is in orange, and the increased share on disposable income spent on fuel in 2026 is in light blue. So again, private consumption accounted for 52% of European Union's GDP growth last year, and last year's Eurozone GDP growth was heavily supported by resilient household consumption, but now it's being affected. The impact on disposable income, and hence turning into lower consumer sentiment, is already showing up, and the willingness to spend has dropped sharply in Germany and Austria. Italy and Spain have also seen declines. And this picture at the right is a survey result. So on to Asia. Oil markets are nearing minimum operating levels in Asia. The keyword is operating levels, not the total amount that's left. And then Europe will likely be the next, followed by US, which might potentially face shortages by July. The global inventory figures are misleading because not every liter of oil can be used immediately. Some still need to be transported elsewhere to be refined, and a large portion of the oil is needed to keep pipelines and storage systems running safely. That means a smaller share is available for the market. Asia is already close to the so-called minimum operating levels. The smaller economies in Asia have already faced the impact. While the US has a strategic petroleum reserve which provided some relief, markets are still concerned, and the pricing suggests that underlying shortage remains acute. For the US, they might enter red zone in July and August. So, leading to this topic, President Trump said the peace deal with Iran is largely negotiated and will be announced soon. And the Gulf states urged Trump to suspend military assault, fearing that the Iranians might retaliate. The current discussion is in the first phase, and then broader talks will happen within the next month or two. And sources say that Iran didn't agree to hand over uranium stockpile, which is related to nuclear issues.